In this video, I'll discuss the secrets of dividend investing and show you how you can use this approach to build a lifetime of income. And we're starting right now. Hey, what's up everybody, and welcome to another video from the Keystone Financial Academy. My name is Elliot, and if you're new to this channel, I invite you to join our community by subscribing and turning on notifications so you don't miss any of the upcoming financial and investing topics. Okay, so let's talk about dividend investing. A dividend is simply a payout of a portion of a company's profits to eligible stockholders. And dividend investing is simply investing in stocks that pay you a regular cash dividend. Dividend investing is also referred to as income investing because you're holding stocks that pay you an income when you own them. But let's back up a bit and see how we got here. So the way most people expect to make money in stocks is to buy low and sell high. When stocks go up in value, it's called capital appreciation or capital gain, and your profit, of course, is the difference between what you paid for the stock when you bought it and what you received when you sold it. So this is a pretty straightforward approach, and most people understand the basics of how stock buying and selling works. But here's the problem. Let's say you buy a stock for some price and then wait all year for it to go up in value. And maybe it goes up a bit, then comes down a bit, then goes up, and then comes right down to the same price again. So a year goes by and you're at exactly the same place where you started with zero profit to show for it. Despite the overall stock market going up over time, you'd be surprised to find out how many stocks don't really move that much at all. Here's something else to think about when it comes to profiting from stocks. Your profit is always dependent on being able to sell your stock to someone else who's willing to buy it for more than what you paid for it. That person in turn will look for someone else who will buy the stock at a higher price still, and so on and so on. This is such a well-known fact in the buying and selling of stocks that there's even a cute name for it. It's called the greater fool theory, with the joke being that there's always a greater fool willing to pay more who you can sell the stock to. This all really points to the speculative nature of the stock market, and in practice this could lose you a lot of money, as stock prices shoot up until the last fool in line hits the ceiling. Then everyone realizes that the stock is overvalued and the stock's price collapses. And finally, it's also worth mentioning that even if the price of the stock goes up and you're able to sell it successfully without the price going down, you now don't have that stock anymore and it can't deliver any future profits to you. So you sold off not only the golden egg, but the golden goose as well. So due to all the issues I just described, there are some investors out there who believe that investing in stocks in such a manner just doesn't make much sense. They don't want to wait around hoping a stock will shoot up in value so they can sell it, and they don't like the fact that once you sell it, you no longer have the asset. Instead, they want to get paid, and not once but on a regular basis, for investing in the company and giving it their money. After all, banks charge an interest rate when they give you money, and that's essentially what you're doing when you're buying stocks. You're giving the company your money. It's certainly reasonable to expect something tangible in return instead of just the possibility of the shares going up in value. Hence the dividend payment. It's the company rewarding you with cold hard cash when you buy and hold its stock. This essentially is the motivation behind dividend investing. So now that you know why investors do it, how does it all actually work in practice? Well, dividends are paid as a percentage of a stock's value and are distributed quarterly, in other words 4 times a year, although some companies pay dividend monthly. The amount you're paid is based on 1 share and is expressed as annual dividend divided by yield. To see what this looks like, it's best to use a real-life example. I've picked 3M, which is a very well-known dividend-paying company. At the time I'm filming this video, its share price is $166.10, its dividend is $5.88, and its yield is 3.55%. This simply means that 3M is going to pay each shareholder $5.88 annually for every share that they own, and this happens to be exactly 3.55% of the share price, $166.10. This, of course, is an annual payout, so you'll get $5.88 divided by 4, or $1.47 per quarter. This is also per 1 share, so if you happen to own 100 shares of 3M, you will earn $5.88 times 100, or $588 annually, or if you prefer quarterly, just divide by 4, that's $147 per quarter. quarter. Keep in mind that this dividend income is based on a percentage of the share price, so it may go up and down as the share price fluctuates. Now, speaking of fluctuations, stocks that pay dividends can of course appreciate or go up in value, so you may be potentially rewarded twice, once by earning the dividend and once by the price of your shares going up in value. Generally though, with a few exceptions, dividend paying stocks are not fast movers. They are stable, older companies, and their share price, when it does go up, goes up slowly and gradually. So it's an added bonus, while the dividend payment is really the main event. Now, when dividend investors pick out what company they want to invest in, their primary concern is the dividend. Now sure, they do care that the company is on solid financial footing, and they may certainly do some researching of the fundamentals. After all, if the company is doing poorly, there may not be a dividend. But the priority is always the dividend payout itself. You want to look for a company that not only has a long track record of paying out a sizable dividend, but also increasing it every year, not cutting it or discontinuing it. Where do you find this information? Well, that's one of the secrets of dividend investing. The document you want to look for is an Excel spreadsheet, and it's called US Dividend Champions. It was compiled and maintained for many years by an investor named David Fish up until his death in 2018, and is now maintained by another investor named Justin Law. It can be downloaded for free at this web address, which I'll also leave in the description below, and as of the filming of this video, the latest version is from August 3rd, 2020. Let's take a look at this extensive document. Here's the cover page, and in the next tab we have a list of what David Fish referred to as champions, or companies that have increased their dividend for at least 25 years. There are 136 companies in total, arranged alphabetically, and the columns over to the right show the number of years of increasing dividends as well as the share price and the yield. So you can easily browse the spreadsheet and pick out companies you may be interested in. There are two more tabs with company listings, including the contenders, which is companies that increased their dividends in the last 10 to 24 years, and finally the challengers, which are companies that increased their dividends in the last 5 to 9 years. As you can see, this is a very useful spreadsheet, and if you're handy with Excel, you can quickly build a few filters to isolate the company, stock, dividend, or yield that you may be looking for. Now, when you buy a dividend stock, you don't get handed a dividend right away. That'd be nice, right? You buy a stock, get your dividend, then sell a stock right away. It'd be like picking apples off an apple tree. Well, it doesn't work that way, and you have to follow a specific timeline. In order to do that, you need to know about 4 dates in a dividend-paying stock's calendar that you as an investor will have to get used to. I'm going to present these in the order they typically happen. The first is the announcement date. This is when a dividend payment is announced by company management. The second is the ex-dividend date. This is the cutoff point by which a shareholder must own the stock in order to qualify for a dividend payment. Anyone who purchases a company stock after this date will have to wait until the next quarter to get a dividend payment. The third is the record date. This is an internal company cutoff date to determine which shareholders are eligible to receive a dividend. Finally, the fourth is the payment date. This, of course, is the day when the dividend gets credited to investors' accounts. Out of those 4 dates, the 2 most important ones are the ex-dividend date and dividend payment date. And in fact, you can see those 2 prominently if we take a look at 3M's stock profile as seen here through the TD Ameritrade interface. So suppose you buy some dividend-paying stocks. What do you do with your dividends once they're paid out and credited to your brokerage account? Well, you can either withdraw them as profit, and don't forget to set aside money for the capital gains tax, or reinvest them using something called a dividend reinvestment plan, or DRIP. Now this is a topic for another video, but essentially a DRIP is an investing plan where all your earnings and dividends are reinvested to buy more shares, which can often be a great way to build up your investment account, especially if you're just starting out. Now if you've been investing in dividend paying stocks for a while and built up a sizable portfolio, you can actually live on these dividends for as long as you own the stocks. It does take a while to get there, as a typical typical dividend payouts are in the 3 to 5% range. So you'll need to buy quite a few stocks, probably in the several $100,000 range, before the dividends from them are enough for you to quit your job. It is, however, doable over a period of years, even with a modest salary, but is definitely not a get-rich-quick scheme. As a final note, be careful about going for the highest possible yields when searching for dividend-paying stocks. It's common for companies on shaky financial footing to offer dividends as high as 10 or 15% in order to attract investors, but those kinds of dividend payouts are not really sustainable for any kind of long term. It's no accident that 3M pays out a 3.55% dividend. That's because it's a solid company and they're in it for the long haul. Its relatively low dividend is actually a sign of strength, as is the fact that they've increased their dividend for an amazing 62 years straight. So take a look at the Dividend Champions spreadsheet and select a few possible candidates for dividend investing. Make sure their shares are in your price range and they're among the champions or the contenders in the database. You're now on your way to becoming a dividend stock investor. Alright, that was an insider's look at dividend investing. As always, be sure to subscribe, hit the like button, and let me know in the comments below as to what topics you would like to see me cover. Thanks for watching, and I'll see you all soon.